Let's talk about the Federal Reserve, because the Fed, as you know, plays a huge role in determining whether we're going to be in a bull market or a bear market, because they control the business cycle for the most part. And the way they control it is by raising and lowering rates, because it all has to do with liquidity. Liquidity is the most important fundamental, and we made a video on this before. If you haven't seen it, I'll link to it right here. So the Fed, to determine whether they want to raise or lower rates, they use a certain set of tools. So it's important to understand what tools they're using, right? So that way we know whether we're going to be faced with a bear market coming up or not. So in this video, we're going to talk about how the Fed actually doesn't know what they're doing, because their tools that they're using are wrong. At least some of them. We'll go over which ones. And you'll see that this actually works in our favor. So they might actually extend this bull for a long while. Now, I like talking about the Fed and macro and stuff because it's interesting, but I'm thankful that I don't actually have to use this information to trade, because it gets pretty complicated trying to analyze the Federal Reserve, and just macro in general is complicated. So you guys know why I don't have to use this information, because I'm a systems trader. I trade momentum and it's based off price action, so it takes all of this into account without me having to actually analyze it, because it all shows up in the price, right? At least that's the theory for anyone following price action, and yes, it does work. And the system that I personally use for a majority of my money, called the NASDAQ All-Stars, it's actually open right now, so you can access it too if you want to, but it's only going to be open until tomorrow at midnight. After that, we shut it down for another quarter, and the next time we open it up, we're going to raise prices at least 50%. So if you want to learn more about the All-Stars, then check out this video that I'll link to up above and down below in the description and comments. From that video, you'll see a page where you can actually sign up for it. And remember, it's only open until tomorrow night at midnight Eastern, Sunday. But okay, let's get into why the Fed is screwing up. So Alex, my partner in macro ops, he just released this new report. He called it "Philip is dead," because we're about to talk about the Phillips Curve actually. So just this week, we got the Senate testimony and the FOMC minutes. So in this report, Alex breaks down what happened. So the first thing he says is that a 25 basis point cut this month is practically in the books, and a follow-on 25 point cut at the September meeting is now also likely. But then what happens from there is going to depend on the data. But the more important thing that we got out of these meetings is the big shift in how the Fed is actually setting these rates. Because remember what I said about tools, they use certain indicators and things to tell them when they should raise or lower the rates. So Tim Dye is a pretty famous guy who watches the Fed. I think that's how you say his name, Dye. Or Dew? Mountain Dew? Anyway, Tim said that the Fed has gradually shifted a key component of its underlying framework. They're very much less worried about the potential of an outbreak in inflation. He says he thinks it's tempting to describe this as the death of the Phillips curve, but that would be too dramatic. More accurately, the Fed just has little faith in their estimates of the natural rate of unemployment, the rate that is consistent with stable inflation. So the Fed's job is twofold. They want to keep inflation steady so that prices don't get out of control, and they want to maximize employment. But according to the Fed and the theories that they use, these two things kind of contradict each other, and that's where the Phillips curve comes in, which is what Tim was talking about. So this is one of the main ideas about how they think this works, where you'll see that a low unemployment rate means a high inflation rate. And the theory behind that is that if an economy is growing, then it's going to have higher inflation. But if it's growing, they're also going to have less unemployment because people have jobs, right? And then the opposite is true too. If the economy isn't growing, then inflation is going to be low. But if that's the case, then unemployment is going to be higher because the economy sucks, no one can get a job. So they're looking at both the unemployment rate and the inflation rate, and they're trying to keep right in the sweet spot. They want a steady rate of inflation and as much employment as they can get with that. But now, as Tim explained, what's happening is that the Fed doesn't trust their own measurement of unemployment. So they're kind of moving away from this Phillips curve idea that they've used for like ever, which is really important because that's how they were setting rates. So Alex explains this more. He says this is a big deal. In the past, business cycles have ended, or rather they were killed, when inflation began perking up while unemployment was low. And you know, the Fed uses another idea called the natural rate of unemployment. And at that rate, inflation doesn't accelerate, which, as Alex says, is a bogus concept. But yeah, like we were saying, the business cycle was killed when inflation began perking up while unemployment was low, because the Fed became nervous during those times. Remember, their job is to keep inflation stable. So if they want to slow down the economy and slow down inflation, what do? You jack up rates. You make everything more expensive. But you know, they would do that based off their little inflation indicator, even if there is deteriorating economic data. So they're a bit myopic in looking at these things. And you can see why raising rates kills the economy, because rising interest rates tightens liquidity. That means everyone has less money in their pocket, including businesses, to spend. Also, higher rates makes bonds more attractive than stocks, because if bonds are giving you a better return because they have, higher interest rates, then you don't want to play with stocks. So money starts flowing out of the stock market, which hurts prices, obviously. So less money in the economy plus the stock market hurting, this dampens business and investor sentiment. People start getting bearish. They start adjusting, thinking that things are going to get worse. And that leads to cascading effects. Less people with jobs because business businesses are tightening up. You know, they're not expanding, they're not raising wages anymore. So more unemployment, people without jobs, that means less demand in the economy as a whole. No one's buying stuff because they don't got money. So again, that leads to more tightening liquidity because there's less money in the system, which leads to rising unemployment again. And then, you know, it's a reflexive loop, and that's how the business cycle turns. And we've talked about reflexivity before and how these loops start and stop, including how the Fed plays a huge role in all this. So I got a playlist with all those videos. I'll put it right here. You can watch that. So the main issue here with the Fed using the Phillips curve is that it's just wrong, because the Fed doesn't truly understand inflation. According to Alex, they never really have. They've just suffered from the institutional scarring that happened when in the 70s we had super high inflation and they didn't really know how to fix it. So all this time, the Fed has pretty much pretended that they understand why inflation is happening, and they use models like the Phillips curve, when in fact, their drivers that they think are causing inflation are just not true. So now finally, if you look at Powell's testimony in the Senate, they've kind of accepted that they don't really understand what actually drives inflation, or at what level full employment is. Is full employment 2% unemployment, 3, 1? They don't really know. And you can see in the statement that Powell kept saying how they're still seeing people who've long been left out of the labor force return to work. So they might have thought that they were at full employment, but the fact that still more people are joining the workforce, that means that there's still slack left in the system. So they're like, wait a minute, maybe we don't know what full employment is. So what the Fed is doing now that's different than before is shifting their focus away from inflation. Now they're kind of okay. You know, if they see a little inflation, they're gonna be okay with it. They're not gonna immediately start raising rates. Instead, they're more focused on other factors. So they're looking more at financial conditions and how wage growth is looking, because wage growth is another indicator of how the economy is doing. If it's increasing, that's good. If it increases too much, then it might be overheating. So you can see in this chart right here that wage growth is increasing, but it's below the past cycle tops. So there's still room to go. The economy still has room to expand. But what Alex is about to explain next is that even this wage growth indicator, the Fed doesn't truly understand that, because the results are being skewed by demographics. So Alex points out that our labor force in the US is growing older and older. And as you probably know, older, more seasoned workers receive higher wages versus the younger people just coming in. But now, you know, they're getting too old. They're getting to retirement age. So more of these older, higher paid employees are set to retire in the coming years. But when they retire, they start affecting the data, right? So the wage growth numbers are actually going to end up skewed. So the average will end up looking lower than it actually is, because all these older guys are retiring. There's a huge wave of them. So what this means is that this key metric that the Fed is looking at, wage growth, like this is what they move to decide their policy decisions, right? Whether they want to increase or lower rates. Well, this indicator is going to stay sluggish for longer than they expect. And that's because of the structural reasons Alex just talked about, the demographics. So they're going to be looking at this, not understanding why wage growth still stays so low. And because it's so low, they're going to just keep being dovish. They're going to keep cutting. And of course, that's great for us that are long in the stock market, because lower rates is just going to keep inflating asset prices. So the big shift that really happened here is that the Fed is realizing that it needs to throw its old playbook out, but they don't really know what to change to, because they don't really understand fully what's going on. They don't know why it changed, but they know it did change. They don't know exactly why the world is structurally different now, but they know something has happened. So they're basically reversing the rate hikes that they did last year because it doesn't align with the deteriorating data. So if you look at everything from this aspect of the Fed controlling the economy, it looks like we're in good shape, at least in the stock market. Because if they keep cutting rates, you know, prices are going to keep going up. And I'm not going to complain about that, because like I said, my system is all about momentum. I'm long stocks. The all-star system that I always talk about is a rotational momentum system. So what it does is just measure the momentum of stocks in the NASDAQ 100 and then rank them. And then whichever stocks have the highest momentum, that's the one that we put money in. And that's just a simple explanation. If you want to learn more, then definitely check out those links that I mentioned before. That video will explain all about the all-stars, and you'll understand why a bull market is really great for this system. It still performs in sideways and bear markets, but you're going to get the best returns, obviously, in the bull market. So if that's extended, you know, I'm happy. All our fallible people signed up for it are happy too. So if you want to check out that system and see a really easy way to take advantage of this bull market and the Fed continuing to lower rates, then go watch that video I linked to, and on that video there'll be a page to sign up for it. And remember, we're only keeping this thing open until tomorrow at midnight Eastern time. Then we're going to shut down access again for at least a quarter. So if you don't want to miss out on 3 months of compounding, you can sign up now, start learning about the system, and get a portfolio ready, especially when markets pick up back in the fall. The system also comes with live coaching too, but you can learn more about all of that in that video. And then also the page where you sign up, it'll explain it more. Definitely go check that out. And if you haven't already, make sure you subscribe to this channel and hit that notification bell so you get an email every time our new videos come out. We publish almost every single day, all about markets and business. So subscribe, and I'll see you in the next video. Stay fallible out there. Bye.